Well, hello. This is Kenn Renner, a real estate expert, broker, author, and speaker, talking to you from Austin, Texas, and appreciate you taking your time to watch this webinar. And Daniel, make sure that you can see it on your end and make sure the audio's there. We really appreciate you once again taking your time to learn a little bit about the Austin market and what the possibilities. We call this cash flow city. And so I'm also here with a good friend of mine and property manager, Rick Ebert, and his cohort, Mike Ebert, who manage Austin Landmark Property Services. And they are experts in the management field, and they are also our sponsors, and as well as good friends, and have managed currently over 200 of my clients' properties. So, anyways, I would like once again, my name's Kenn Renner, real estate expert, been in the business for 30 years, and one of the things that you're seeing right here is a picture of beautiful Lake Travis, which is 14 miles west of downtown Austin, and that boat on it is actually a friend of mine's boat. And when I moved here in 1993 from Austin, I'm from Southern California, and one of the first things I did was get out on this lake, and I could not believe how beautiful it was. Not only that, I felt like I was in the middle of the country, but also the temperature of the water was 85 degrees, and there was nobody out there, and this is what it looked like. So I kind of asked myself, I came out here on an investment trip, what is wrong with this picture? And I kept on asking myself that question, and I couldn't come up with anything that I came up with that was wrong with it. It had clean air, clean water, great culture, and so I've made moves not only to invest my money here, but also to move here back in 1993. So, Daniel? There we go. All right, so just once again, give you a little quick rundown. We have a lot of slides to cover. If you've ever been to one of my webinars, you're gonna see definitely a fire hose of information. So I'm going to blow through a lot of the stuff that maybe not as important as the other stuff. We're also giving opportunities to attend future webinars coming up later on. Once again, 30 years in the business. I'm a broker and I'm an investor. I invest in the products that I sell out my clients. I moved here from California in '93 to become a bigger fish. Being in California, it was hard to get ahead because everybody's working 80 hours a week. When you move to Texas and start working in this market, you realize that people are a little more laid back, so it was easier to get ahead. And in the past 6 years, I've closed over $100 million in real estate, mostly single-family homes, mostly to investors. Sold over 500 investors properties in the last 6 years. I'm also a national speaker and author and recognized real estate and also video expert. If you watch House Hunters tomorrow, it's going to be on Thursday at 9 p.m. Central Time, and it's 10 p.m. Pacific Time, and that's going to be tomorrow, August 23rd. You'll be able to watch me take Dr. Hofarth and Dr. Krista out looking for homes where they actually end up buying a property in a lakeside community of Rough Hollow. So enjoy that. It's a great show. And it'll be tomorrow on August 23rd at 9 Central, 10 Pacific. A couple books that I've written, you're welcome to go to my website and grab those. They are some great resources. This is a free guide. I know we have some, we do have some realtors on the call, and this is my latest book. It's free to you. You can go to videoquickstartguide.com and you can download that for free, or you can go to amazon.com and buy any of my books at Amazon as well. But get it for free. It's be downloadable PDF. All right. So one of the other things I've got is I've got the #1 ranked real estate video channel in the nation. It's YouTube with over 10 million views. And I'll be speaking at the Texas Association of Realtors Convention on September 7th. And what's real exciting for me is I'm coming out to California to do a presentation as a keynote speaker for Success Convention's Real Estate Forum, which is going to be at the Hyatt Regency, Irvine, October 24th and 25th at 7 p.m. And it'll be 2 hours. It'll be back-to-back the same seminars, both on the 24th and the 25th, just because I wanted to make it convenient for people who couldn't make it on either one of the days. We will have our sponsors, Rick Ebert from Austin Landmark Property Services. We'll probably make a Skype interview, and then we'll probably have our lending partners, Prime Lending, as well. Hopefully they'll be there in person, but it'll also be streamed live, so that's kind of neat. You'll be able to watch it live on the stream if you can't make it down to Irvine. There's the information there. One of the things that you're going to have is I'm going to be sending you this information. Anybody that signed up to the webinar via a YouTube video. Because there is so much information I'm going to be covering, there's no way you're going to be able to even keep up with the notes. So that's why I'm going ahead and having you have the YouTube video, so you can always go back and check out what you might have missed, including this information on my upcoming the seminar that I'm going to be putting on at the Irvine Hyatt in late October. We'll also be, one more thing before I jump in here, we'll also be looking at the last Wednesday in September, we'll be doing another real estate investment webinar, because we'll be doing as a lead into the Irvine seminar, and that's going to be at the last Wednesday on September 26th, same time, same place, on Wednesday, 2 p.m. Central, 12 noon in California. All right, so this is an interesting shot. I took this shot from the Hyatt Regency Hotel in downtown Austin, and I believe this was 2003 or 2004. Not more than a year ago, I went out and took this picture of the downtown Austin skyline. So I just show you a little bit of a contrast here between where it was in 04, a little less than 10 years ago, and where it is now. We have really grown as a city, and we are one of the fastest growing cities in the nation, and people are moving here from everywhere, and that's what we're going to be talking about. We're going to be capitalizing on the people that are moving here from out of state. But that's a pretty interesting display of the massive amount of development. Most of those new high-rises that you see are downtown condos. It's not just been condos. It's been everywhere from infill all the way out to suburbs to brand new communities. All right, so real estate, we are the comeback kid. You know, markets change, and what we're looking at is that, you know, I think it was it Warren Buffett, or was that funny commercial that said buy low, right? That was the whole commercial. You remind me, Rick of the guy. You look like the guy that was the buy low guy. So we actually have opportunities right now to buy low, but we also can follow historical trends, and we're going to show you some of those trends here. There's only a few places you can store money, and when you really, really think about it, you got stocks, bonds, commodities, savings, your mattress, and real estate. And I can tell you that there is no better time to invest in real estate. It's the best time in history, and there's a really good reason for it, is that the mistakes that were made in 06, 07 crash of the mortgage market are not being repeated now. The investment sales actually account for 27%. Now, that's a 2011 figure, but it actually accounts for 27% of all new and existing home sales right now. So investors are buying, and we're, you know, hopefully you'll be one of them, and hopefully you already are one of them. And the other big thing that is something that is incredible is the lowest cost of money in history. So you have an awesome opportunity to buy properties at great value at the lowest cost of money in history. And when Rick and I started looking at these numbers, we started looking at the rates being in the 4% range for non-owner occupied, and seeing how our rents in some areas have jumped 20%. We were like going, wow, these properties are cash flowing, and that's what's leading to this comeback in the market. Let's talk about what Warren Buffett, Mr. Stock Market himself, says about single-family homes. This was off an article from CNBC just a few months ago. It's a single-family. Warren Buffett said himself, with equities along with the stock market, single-family homes are a very attractive investment right now. If held for a long period of time and purchased at low rates, Buffett says houses are even better than stocks. Buffett says he'd buy up a couple 100,000 single-family homes if it were practical to do so. One of the things that Rick's telling me, that there are hedge funds coming in and buying up large blocks of the foreclosures and things like that, the REOs, right?
That's right, Ken. We've been approached by investment groups that are indeed doing the very thing that you're talking about right here. Warren Buffett has said the same thing, which is basically go out and buy low, buy at the right time, buy at the right location, and then hold these in a fund and have those professionally managed, and you have a good return on your investment.
So one of the things that we'll be covering in the next webinar coming up in September is where we come up with the funds. And one of the sources is self-directed IRA money. People are tired of the low returns that they're getting on the stock markets and things. So there's opportunities. And this is kind of a funny thing. We started looking at the stock market. I'm not against the stock market. I'm just not invested in it because I can't handle the ups and downs. And this was a 5-day change. It kind of reminded me of a heart monitor. It's up, it's down, it's up, it's down. And, you know, this particular thing, we're up 8.23% on the Dow Jones. But in reality, it's over time. And when I looked at a 5-year, this is over 5 years, starting in 2007. And if you were to buy into the stock market in 2007 and you held onto that stock for 5 years, you would actually now be, if it was an average of the Dow Jones, you'd be at 4.82% down. Real estate's different. I'm going to show you some charts that if I overlay this, you'd be like amazed. But the fact of the matter is that I just don't think I have control of my money. In fact, I think a lot of the stock trading is done electronically, automatically. And it's almost like somebody's pulling those switches. I don't know who it is. And I just can't, I can't, invest my future on maybe what happened in 2008 or what might happen in the future. We don't know. But this is reality. This is the reality of the stock market. So I'm encouraging those to take a little bit of your stock market portfolios, your 401ks or whatever it is that you have out there that may not be having the greatest returns. Maybe they're doing great, but why not diversify a little bit into real estate? And the single-family homes are one of the safest and the most practical, and that's what we're going to be talking about today. So, I don't want to get into a whole lot of details about real estate, why you should be investing, but the bottom line is that there's so many advantages to it, and one of the facts is that 85% of the people who are rich or wealthy made it through real estate. But there's some really great advantages of leverage, appreciation, depreciation, and write-offs. We'll be covering that in the next webinars more in detail. I want to talk about the Austin real estate market. I don't want to talk about real estate investing in general. We'll get into that later on. And once again, these will be recorded, so you can always go back and watch stuff that you missed. And when the next one comes out, you'll get a copy of that as well. One of the things that we look at is that someone else is going to pay off my mortgage, and that's something that you don't find in any other investment. The debt will be paid by somebody else, and then eventually it's free and clear. Roy Rogers said, find out where people are moving and buy land. And I think he was being funny, but I think he was also being truthful at the same time. It's pretty simple. Find out where they're moving and buy land. Well, we like property. Land's one thing, but it doesn't offer you income. So we put property in there just as a little suggestion, and that's real estate, whether it be 1 to 4 family or whether it's apartment buildings or any kind of real estate. But the trends follow historical patterns. And that's something that I've studied. My father was a real estate attorney, and he was the one that first got me studying the cycles of the market and watching what happens with trends. And one of the things that we noticed, and this is a chart that I've presented in many of my seminars back in 05, 06 out in California. I started coming to California in 04 to do my presentations because of the fact that I saw the bubble coming, and I told my friends and the people who attended the seminars out there when they had 17% appreciation in 1 quarter, I said, this is crazy. Everybody knows it's crazy. It's going to bust. And about 5,000 people should have moved their equity somewhere else, but they didn't. But 500 of them did, so I'm very blessed with that. I appreciate the fact that 500 people bought homes, and some of them bought multiple homes from me, which about 85% of my investors still own those homes. And that says a lot, that they know that they're into it for the long haul. This is not a short haul. And if you do still own your homes, and if you're even on this webinar and you're one of my clients, maybe we'll also help you get hooked up with prime lending and get that thing refinanced down on the 4 or 4 1/4. Because to refinance, you can either pull cash out or just hold on to it for the long haul and get those payments down. And now with the rents going up, it's an incredible opportunity. But what you'll see here is going back to the 1980s. We have counter cycles that have been the difference between California and Texas, and it has a lot to do with migration. When things are booming in Texas, they're kind of in the doldrums in California, and this is what's happened right now. But if back in the 80s it happened, in the 90s it happened, the 2000s it happened. The only thing that happened in the 2000s was we had a hyper run up. If you take a look at the chart here. In Texas, we had an oil boom and a real estate boom that drove prices up, and that came crashing down. And was it, Rick, you were around 85?
It was 85, Ken.
1985 is when the world came crashing. It was probably worse than it is, way worse than it was now. I mean, I remember
It was vacant city back then.
Yeah, they basically. I remember looking. I was living in Anchorage, Alaska at the time. I remember looking at the statistics that 50% of the commercial real estate was empty in Austin, Texas. I said, well, "What's wrong with that town?" But they overbuilt, and it's not nearly as. And Austin was not nearly affected on this last go around, and there's a good reason for it, and I'll tell you. But then California had a huge run up into the early '90s. And that's when I started looking around in Orange County, and the qualifying rate, how many people could actually qualify for a home, the affordability factor was down to 8% in that early 90s. And what that led to, in other words, only 8% of the people, 9% of the people could afford a median price home. I said, this is trouble. There's only 9% of the people can afford a median price home. And my business is in real estate, and my business is in lending at the time. I said, I got to go find another place in the nation, number one, to invest. I didn't want to invest in a market that I knew was going to go down. I'm studying these cycles. They go back into the 70s, these cycles. And so sure enough, I started investing my money out here in Austin. And sure enough, between 1998 to 1997, Daniel, how do I get back?
Hit the left key.
All right. From 1990 to 1997, we had in California one of the largest drops in values, and the worst foreclosure rate was actually 97, 98 in California. Well, in the meantime, we had in Texas, we had a tech boom going on, led by Dell Computers and among others, and that led all the way up into 2000 time frame. And what happened in 2000 was Dell and the whole dot-com thing came crumbling down. And so what happened is the values ended up going, well, we didn't have a crash. We call a soft bust. And in other words, the values pretty much flattened out. Some of the high-end stuff got hit pretty hard, and just as it did in the last go around. So, Daniel, here's a question here. Loss of sound. Is it being recorded?
I still have sound.
Okay. It is being recorded. We do have sound. Let me go ahead and so you still have sound, Daniel? Okay.
Yeah.
All right. So if you guys can't hear, just let me know. There might be something. The internet's fun stuff. So, okay, sound is back. Great. All right. Let me get out of this little guy here. All right. So going back to the chart here, where we saw that in California, when the dot-com bust hit, guess where all that money went? It went out of the stock market. Guess where it went? All that dot-com money went into real estate. So the investment of the stock market, they took all their money and started putting it in California. Well, that led to a feeding frenzy. Started off slow in the early 2000s, but then just started going and going and going. Well, in the meantime, the administrations allowed for and didn't keep an eye on what was going on in the lending market, which is really driven by, believe it or not, Wall Street. They were driving up with all the way they had structured the whole mortgage industry, allowing anybody to borrow money. Well, that led to even more investing and more speculation, which drove to a higher appreciation. And in California, it drove it to the 2 years past what would have been a normal cycle correction. Not only did it drive 2 years past, but it also drove it up farther than it ever should have gone in the short term. It wasn't following normal. It was hyperinflation. In Texas, we had an opposite. We really were kind of coming out of that doldrum from the dot-com, and we did have a boom, but we had more boom in volume than we had a boom in values. In other words, we had 16,000 homes constructed in 2005, 2006 time frame. When the whole market, the mortgage market, collapsed, the Austin pretty much for the last 4 or 5 years just remained stable, and part of it was because we didn't have the big run up. Well, we know what happened in California and other parts of the nation, Florida, Arizona, where there was just over speculation. We had an incredible crash. So, but the point being here is that now a lot of these folks that are living in these other areas that are so devastated by the economy, they're looking for jobs, and that's where we come in. Austin has the #1 job growth in the nation, and that's why people are moving here. Let me prove my points here.
Click on the screen.
We're undervalued, great place to live, we're affordable, people and companies are moving here. I can tell you several companies I've worked with directly, including Now Apple Computer is moving in. They're building a facility that will eventually have 3,000 people. We have high rents, low vacancy, and the highest job growth in the nation. We have some incredible, things. First of all, we're the capital of Texas. We're the seat of government. We're not only the capital of Texas. We're also the Travis County is the capital, or the county seat. So we have both state, local, and even federal industry here. But University of Texas, largest university in the United States. We have that great Apple Computer facility coming in North Austin. A huge Formula One track that's going to bring in hundreds of millions of dollars in business to our economy, and that's going to be. Is that November? So come on out, and visit us, and we'll take you down to the Formula One track. We'll watch some racing. 300,000 people will be coming to our town. Of course, we also have the live music capital of the world and the famous festival, South by Southwest in Austin City Limits. People, especially movie stars and people from other parts of the nation, love coming here because, first of all, we don't have paparazzi. At least they haven't found us yet. So they can feel, you can actually see movie stars and music stars. They walk around, they go to a restaurant, they don't have to feel like they're going to be harassed where, in Hollywood, they just get chased down. And I'm not going to read all these employers. You know who they are, and Whole Foods probably being one of the poster childs for the Texas market. Okay, let me tell you exactly what happened in the 04 to 07 rush. First of all, it started in the Sun Belt states, including California, Arizona, Nevada, and it headed east. And Austin was kind of at the tail end of that investor run. What I mean by what was happening, the easy, greasy money was funding people that were buying homes for the wrong reasons. They were buying them empty houses because builders could build them, and lenders would lend on them, and the values were pyramid scheming up, and that was a unhealthy thing in those areas, which we've seen the results. In Austin, we had a run as people kept moving east because Nevada got oversold and felt like that was at the end of its run, and Arizona kind of got at the end of its run. People started bringing their money to Austin, and that's where I sold, several hundred homes. But I only sold homes in areas that were, and just as today, that were solid, strong areas. I never went out to areas where people didn't want to live. And a lot of those investors bought in areas where people didn't want to live. So that all ended in 2007. We had a glut of rentals. Remember that, Rick? We had 260 homes in Round Rock East, and
my memory is still
yeah,
with that image.
Yeah, over 200 homes. These are small, not small, but there's sections of areas that didn't need to have 200 available rentals, and so. But we were very conscientious and knew that since we were selling so many homes, we made sure that we were involved in helping getting the properties leased. If Rick remembers, we spent a lot of money marketing these puppies, and then Rick took them over and then just handled it from there. Investors, then now between 2007 and 2012, here's what's caused the housing shortage. Investors have sold their owner-occupant their investor properties and the people that have bought those were probably first-time home buyers, owner-occupants. So investors sold their properties for whatever reason. Maybe they got married, maybe they got divorced, maybe they had death in the family, maybe they were just trying to liquidate some equity so they could cover their losses from other properties in other states. Whatever the reason is, we've had an increasingly drop in supply of investment rental homes. In the meantime, apartment occupancy goes to 97% because of all the people moving here. Houses go, we're at 90, what are you at on your?
We're about 97.5% occupied in our portfolio.
So Rick has manages over 600 properties and 97.5% occupancy. The first-time home buyers really, if they're buying up the inventory because they are tired of paying these high rents. So if they can buy, they will buy, and they'll buy one of these little investor-type homes. Another thing that's a factor in our shortage in rentals is that many are forced to rent. People have had short sales, other parts of the state, they've had, difficulties, whatever it is. They're just moving here, and they're self-employed, but they're making good money or whatever. Bottom line is they can't get a loan. And, of course, the highest job growth in the nation has caused this incredible migration. One of the things that we've also seen is I talked to Kent Zarbach, president of D.R. Horton here, largest builder, and also spoke to April Solomine, who's the vice president of Meritage Homes and another major builder here. They both agreed to the fact that we have a labor shortage, so that's driving labor prices up. We have a materials shortage because no one knew that our economy was going to take the turn and as quickly as it had, especially here in Austin. And we have a lot shortage. I still don't see bulldozers out there turning up the ground, making up new lots, and a lot of that has to do with the fact that there's not as much investment money in doing improved lots. So so that's where we're looking at is that the builders are forced to raise their prices. And I saw in Highland Park North, which is a community in Pflugerville, I was out looking in that area. A basic bottom line home in that area, brand new with D.R. Horton last year, was $135. Same model's $160. So, you know, we have to be careful too, because if the prices go up too quick, it doesn't make it as an advantage for the rentals. But there are certain areas that we target a lot that would be an area that has great rental rates and new or a couple of years old. I think our sweet spot, Rick, is a 5 or 6 year old home or 3 or 4 year old home that's got the bells and whistles that can be bought at less than what you could build it for.
Well, that'll always be the sweet spot, especially if it's one story, 1,600 to 1,800 square feet. You're right, Ken.
Yeah, and so, you know, those are the kinds of things. And, you know, a little bit, I don't want to go too big, I don't want to go too small. I kind of try to stay out of the low end too far because you seem to get a lot more turnover. And seems to me that medium price range, which right now is just over 200,000, you know, 175 to 200,000 seems to be the sweet spot. So anyways, with all those things coming into play, we have a rental housing shortage. And it really didn't come to my knowledge until I started looking for client for property about what, January, February is when this housing shortage really took its. I mean, we've had some good increasing rents over the last couple of years, but then I started looking at the lack of supply. This is a chart. I know it may be hard to read, but come back and visit it because this took us a couple of days of research. And what I'm showing you here is different parts of the city as a cross-section of typical areas from north to south, all the way from the northern suburbs to the southern suburbs, all the way out to where I live, Lake Travis area, all the way out to the east side where there's more just prairie land. But look at these rents here. These are your averages. Right now, for Cedar Park is an area that's a suburb of North Austin. Avery Ranch, one of my areas, I own several investment properties. Now, I'm looking across here, and we're seeing, and we also compared this to 2007. And so if you look at the chart here, where we have average 2012 rents is 1731, and average 2007 rents were 1440. One of the things I want to encourage you, and I'm going to encourage my current clients, and I'm encouraging Rick and Mike, that a lot of people are renewing their leases, and not saying with Rick's firm, but not really looking at this and realizing that we've had a potentially 15 or 20% increase in rents, and it's helped. And when they try to go to sell it, especially if they're selling it to another investor, it can kind of hurt their ability to get top dollar for it. So we want people to be getting market rents. But if we look at this, the typical what we were getting in Avery Ranch for a 2,000 square foot home for so many years was $1,395, $1,395, $1,395, $1,395. Now we're looking at between 17 and 1,800, up 20% from 2007. You look down this chart and you'll see Cedar Park North is 15%. Here's another interesting figure. Look at the days on the market: 12 days, 15 days, 13 days, 14 days. Avery Ranch, my little poster child, 10 days, average time on the market. Look at our months of supply over here, 1.35, 1.1. Oh, gosh, I hate when it does that. I have to get a better cursor here. So anyways, let's go back in here. All right. I'm just going to go ahead and read up. In South Austin, which is another area, we have a 0.55 month supply. What's a healthy month of supply for rentals? 2 months?
You're looking at 2 to 3 months.
Two to 3 months supply would be a healthy supply for a landlord-tenant type of ratio. Well, the bottom line, the tenants don't have any advantage right now. They used to be able to, if you raise the rent $50, they'd move. Now they're smarter than us in a lot of ways. They realize if you raise it $125, it's still going to be below what they're paying now. So, and then the cost of the move and all that kind of stuff. The highest area of, and I've told my clients for all this time, the highest area down here towards the bottom is Lake Travis, which is where we're at right now, has had the highest increase over 2007, 30% increase in rents. You know, I'm out here. I told them, I said, hey, the The hospital's coming in. We need people. They don't have rentals out here like they need them. They don't really even have that many apartments. Buy out here. It's a higher demographic. It's the highest demographic in the state of Texas. But, you know, one of the things that we do is encourage our clients who may want to move here as a retirement home or a second home to come out here and buy themselves a property and rent it out until they're done in whatever part of the country they are. We have a lot of Canadians coming into Austin buying property just so they have something to move to or get out of the winters. We have a lot of people from Mexico coming in here and paying cash to get out from the political turmoil. All this pressure is on Austin in a good way. But here's the reality. This is taken from the Texas A&M University Real Estate Market Center. They've got an awesome research center. And if anybody that's on my webinar here I'm going to be sending them a PDF of the 97-page report on the Austin, Texas market. But this is our job growth. According to Wall Street Journal, we have the highest job growth in the nation. And so, real estate follows the jobs. Real estate values, real estate rents, and there's no end in sight for our jobs because people keep moving here. Here's another chart. Showing the recovery over Texas as opposed to Austin. We're just leading Texas, and Texas is leading the nation out of the recession. We were the last one into it and the first one out. This is Jim Gaines gave us these quotes. We're just doing better than most of the nation, and that's good. Here's a Texas population chart, and nothing but, guess what? These people have got to live somewhere. And I'm going to show you a chart that's going to go that more of them are going to be renters than ever before, which is great for landlords. I'm going to show you a chart that's going to prove that here in a second. Take a look at Austin. Now, Jim said that this chart would be actually a little steeper than what he actually put here. But we're looking at doubling our population by 2020, 2025. And there are 46,000 people a year have been moving here to Austin. They got to live somewhere, and we're not building them fast enough. And so not only we're talking about cash flow because people bought on speculation before. We want cash flow. Yes, we want appreciation, but that's not what we're banking on in 2012. We're banking on cash flow. This is a chart that's very interesting. I'm turning 49 this year, and so I'm at the very end of the baby boomers here, and so we also have what they call it, the baby bust, the Gen Xers. But the largest population is what's called the Echo Boom, or our kids, 16 to 34, and they are going the biggest segment of the population in Austin, and they are also going to be the ones that would be the most potential for, obviously, housing. Now let's take a look at what happens here. We're seeing that the home ownership rate, which exploded in the 90s and through 2005, went way too far than it was healthy. And it was driven a lot by the easy, greasy money. But there were a lot of people that shouldn't have borrowed, that shouldn't have been homeowners. And Jim Gaines, the economist that did this chart, said that this will probably balance out around 64, 63%. This is U.S. nationwide, and he said about the same for the Texas market. Well, the thing about it is that these Generation Xers, these Gen Ys, these Echo Boomers, they're not so sure they want to buy as much as they should. So they're going to rent. So the biggest population is going to, and that's coming into the Austin market, is probably going to rent, at least for, they're not ready to buy. They're not ready to build a family and buy. So what's that going to do? Continue to drive rents up. Here's another chart just to show you, going back to 96. Don't take my chart's word for it. These are down in the left-hand corner is the Austin market and the appreciation factor. It really has done nothing but go up, flatten out, go up, flatten out, maybe drop a little bit, but it's not the big swings that you'd see in other markets. This is a very interesting chart going back to 1990, before I even got here. But Rick was already in the business. You were in 86 is when you started doing the property management, so you're 4 years into this, when you could buy a house in Austin for $73,000. Now look at that. In 2012, it's $200,000. The point here is that the prices in Austin, historically, doubled every 15 to 17 years, maybe 20 if you counted the wrong troughs to the wrong troughs, but really 15 to 17 years. And this is one of the strategies that we have for our clients, is that if you're going to want your kids to go to college when they're born, buy them an investment property, hope that the trends of appreciation here in Austin follow the same trends, that home will be worth double in 18 years. You put it on a 15-year note, it's paid off so that the kid's education is paid for. So let's say you bought a $150,000 property, it goes to $300,000. I can't guarantee appreciation, but this is what the economists are saying. And then you have it paid off over that period of time, then you could turn around and sell that. Your kids' education is paid for. So use our college retirement or your college strategy on how to pay off. Just with one single family home can certainly pay maybe even for all of your kids' education. Another chart that's written, these are stats, these are statistics. And he said, Jim Gaines said in his report that he's going to have, looking at an average appreciation of about 5%. We're actually seeing that right now. We're seeing a 5% appreciation. Finally, if you noticed from about 07 on this chart to about 2010, 11, we've really been flat, but now we're starting to see those increases just because of what I said. Shortage of supplies, labor, demand for housing. People are moving here. There's no doubt people are moving here. They're going to buy or they're going to rent or they're going to do both, and that's going to economically drive our. What's nice about this chart is you don't see any of those huge 17% per quarter raises that we saw in the crazy markets in other parts of the country. It's much more stable. Our months of inventory is down. An average month of inventory for an equilibrium market is about 5.5 to 7 months. We're down to 4.5 months supply, which probably going to now, just as we're seeing, is leading to appreciation. So don't forget just cash flow. We're also looking at, we are going to start heading towards appreciation as our inventory. Definitely a seller's market. Back to my famous chart. This chart has actually helped me put hundreds of people into homes when they finally realize into their investments that they can, obviously roll. If they've owned property, like we have some clients that's owned property in California since 1990. Hey, it might not be a bad idea to take some of that property and roll it over into some areas that other parts of diversify out. Or once again, take a look at your stock portfolio and look at the fact that you might be able to diversify. Okay, so I'm going to give you just a quick, a little more feel. We've done a lot of charts and statistics, a lot of my opinions, and a lot of facts. But what I do want to show you is this is a beautiful city. Yeah, it's clean air, clean water. I want to just give you a tour of some of the, just quickly, why I moved here. One of the things was the high level of education. My kids are going back to school next week, and they can't wait. That's not like me and Rick when we were growing up in school. I mean, they want to get back to school. They're straight A students. It's like, I mean, it's cool to be smart here. I'm just totally different than when we growing up in California in the 70s. Okay, it's the Capitol, beautiful place. Come down and tour it. Built in the 1800s, 4 feet taller than the U.S. Capitol. I know Texas, everything's bigger in Texas. We got the high tech going on with Apple Computer. This is Dell, obviously. They've been around forever, but we also have Apple coming. That's huge, and more. Samsung, some of the biggest high tech companies in the world. This is actually an old picture of the toll roads that I took back when I was doing my previous presentations. I didn't have a current picture, but the toll roads are up and running, and that's what Rick was telling me has given us a little bit more leverage in the suburbs of Hutto and Pflugerville, because the toll road goes right through it, State Highway 130, and it's made, I mean, really, you can get cross county in 12 minutes. It used to take a half an hour, 45 minutes. You can get from all the way north of the suburbs of Austin down to the airport or south within about 20 minutes. What's it, 75 miles an hour? 75 mile an hour speed limit. So everybody's going 85. It's not like California, they're going 90. But, great quality of life, out golfing. This is Terra Vista Golf Course. I took all these pictures. This is the Avery Ranch Golf Club, great place. It's all public, and you go in there, it's not crowded. You can go in there on Saturday night, it's not crowded. It's, there's a view from the golf course, from the clubhouse. Just come out and have a cup of coffee and enjoy the view. Wonderful lifestyle. I played that golf course so many times, and my wife finally said to cool it. So there we are again. Just having a good old Texans they just love their recreation. There's the clubhouse, and took that picture during a beautiful sunset. Boating is big time. In fact, my house is located right at one of the top of one of these hills overlooking this lake, Lake Travis. Lake Travis is it's 14 miles west of Austin. We also have several lakes. There's 7 lakes in the Highland Lake system, but everybody loves to get out on the boat and go, and it's really easy to do so. It's 225 miles of shoreline, 75 miles deep. 75 miles long. You really get lost out there, and just a great place to hang out. And that's our ocean, is, so to speak. And if you see that island, it's called Starnes Island. If you remember the Spy Kids 3 movies where they were on the island, or on that little, that was where they actually took these pictures. There's another, just marinas. After marinas across from here we're looking over to Carlos and Charlie's, which is a lakeside restaurant. We've got plenty of lakeside restaurants. All right. We're going to skip over the business of being a real estate investor because I'm running out of time, and I want to get to what you probably came here for, was to give me some actual performance. We're going to cover this section, tax strategies with real estate, on the next webinar, which is, like I said, the last Wednesday, September 26th. This section, we could spend on these 4 slides here. I could spend a whole hour, and I don't want to cut it short. And once again, if you don't make it, I'll definitely send you, if I got your email address, I'll send you the PowerPoint. Now, this is where it gets into one of the reasons why Rick is here too, is that this is out of the Gary Keller's. I'm with Keller Williams here in Austin, Texas. They're the largest franchise in the world. Actually, they're just behind Coldwell Banker. They're expected to overtake them as the largest real estate company in the United States here by next year. Not quite there yet, but out of his book, Millionaire Real Estate Investor, which is what I'm going to be teaching out of coming in the coming months, is what a millionaire and real estate investor does and puts together their network of help, networks of help. And you've got you in the middle as a millionaire real estate investor. You've got your inner circle, mentors, partners, consultants. I like to help fit in that inner circle because I really care about people. I care about their investments. I'm a real estate investor. I want to share my 20 or 30 years of doing this, so that people do it right and hopefully don't make the same mistakes I've done. Then beyond that is your support circle, and we got our property manager, Rick Ebert, to answer questions as well, and hopefully our prime lending associate, Sherry Eckert, who's our sponsor for the Irvine event, as well as Rick. They're part of our hands-on. We're just arm's length from these folks. Of course, you got attorneys and accountants and contractors. Those are people that you need to have in your support circle. If you don't have them, we can help you find them. And real estate broker, of course, is right there at the top. And having somebody, I know almost every street, as Rick does and Mike does. I almost know every street in this town. I know where to buy and where not to buy. And if I have a question, I'll ask the property manager. I get this question all the time. Why don't you buy a fourplex over in this area? What'd you say, Rick, one time? Well, if it rains, then the people that are wiping the cars off can't go to work, and so you don't get your rent. So
that's correct, Ken. Also, they find that a vacuum cleaner to them is a luxury item.
Yeah. So, I'm not against fourplexes. I'm not against duplexes. I just will explain that in Austin, there's just not a big plethora of good ones. When you find a good one, nab it up, snap it up, get it. But don't fall for those super high cap rates that they put out there and realize that you're buying something that has mold. All right, and then of course you have your support circle and your service circle, which the property manager and your advocates are going to help put together. You're not going to have to hire electricians and carpenters and painters and all that kind of stuff. Lawn service, that's all done by the property manager. So a lot of the support service circle is handled. But this is a great chart. If you get the Millionaire Real Estate Investor book, it's on page 159. I think it's a great thing to study and make this as part of what you're supposed to build. One of the things about most real estate brokers, most real estate agents, they don't have this. In fact, believe it or not, I'm not to take anything away from my cohorts, that most realtors don't even own investment property, and it's a real shame. They have insider information. Insider information and knowledge is legal in real estate. They just don't get it. But I'm encouraging my cohorts to buy investment property. Our sponsor, Prime Lending, is one of those in the inner support circle, and they are one of the few in the country that truly, honestly go up to 10 properties. They have the interest rates in the low 4s. I've got my APR disclosure on the next page in case we have any RESPA cops out there. They have as little as 15% down, and this is great. They have different amortizations that are standard for them: 30, 25, 20, 15, 10. We're seeing with where the rents are right now that you can break even with 20% down on a 15-year mortgage. And what that means in 15 years, that note's paid off. Once again, wow. When you're 15 years from now and you're retiring, I'm 49, I'll be 65, 64, or no, just 69. I'll be 69 when that note's paid off. But that's great. We talk about that in the next webinar. We're going to talk about the single family home retirement strategy. And we're going to talk about the using self-directed IRAs as a way to help you get to your retirement. We found out that prime lending also lends 10% down on Fannie Mae Home Path, and that's really got me going because you can go 10% down on foreclosure property. Amazing. And so there's our information. It's Sherry Eckert. Come back to this slide on the video if you would like to get her information, but it's there for you. And then our sponsor here, Rick Ebert, is he's been in business since '86, and like I said, manages over 200 of my properties, and he's been chiming in on us here. And then my job is to be your representative. You can read through this guide because I want to get to the performance, but the bottom line is I'm here for you from beginning through acquisition through end. And I'm your eyes and ears here. But I do encourage you to come out and visit your properties, and there's a strategy in how we do that. And I'll explain that. Got a great reputation out here, and I'm not just saying that. It's just because I've sold so many properties, and I'm doing it right and keep people in the right neighborhoods. And builders love me because I don't blight the neighborhood with a bunch of people, mismanaged properties. So they give me more, and builders are really warmed up to. And I like new properties for investors in the right areas that aren't overinflated. So. Okay, I wanted to show, Rick and I were talking about what a typical property would be, and we're going to show you some rents. Let's go ahead and see. We have a question here. Sound is back. Well, I hope so.
I think the minimum is the same one from before.
Okay. Do these prime lending rates offer apply to only individual investors, or if three friends wanted to get together and buy their first investment property? You can get a partnership together and buy investment properties together. There's a strategy for that. But it's probably best you get together with us and handle and ask us personally, because there's some ramifications to have multiple owners on a property, and usually it's best to have one qualified. See, you want to tie up all your qualifying power when you have three people on one loan. That counts for a loan for each of them. So anyways, your typical property that we've got, this is a 1,700 square foot, one-story home, 175 is the inside of it. Your typical nice open 3-bedroom, 2-bath. Here's something that would be more on the lower end. This is in Brookfield, which should be about 125, 130. This is probably kind of similar. Rick just bought a property. Tell us, Rick, what you just bought.
Well, Ken, I bought a property that's about 1,700 square feet in Heather Wild. Did that in May of this year. Paid $127,000 for it, and I rented in 2 weeks for $1,300 a month. It looked pretty much like the one you just showed.
Yeah, so $1,300 a month for $127,000, and he paid cash for it. Took some money out of the stock market just for diversification purposes. But we'll show you some numbers here that will allow it. Even with 20% down, you're going to have a couple hundreds positive. And if you put more down, obviously you can have even more positive. Obviously, it's all positive to him because he doesn't have a mortgage on it other than his other expenses. We're seeing that. We can actually, back in the old day, you couldn't apply cap rates very easily to single-family residential, but where our rents are right now, we're looking at 6, 7, and 8, and even beyond caps. I ran these cap rates. If you're a commercial guy, you know what I'm talking about. There's a typical Avery Ranch single-family 2,000 square foot home. I used to actually own this property. I'm very familiar with these kinds of homes and what they're getting. These were $1,395 all day long several years ago. We are now getting almost up to $1,800 rent for that. This home, I've got one same model available right now that's offered at $203,000. So those numbers work really, really well. And he's an investor himself. He's a millionaire investor. He wants to sell this property and buy a condo downtown because he can. So, but he wants to sell his property first. So he got a tenant in place, and turnkey investment property. So if you're interested in that, we'll tell you. Here's a similar model one of my investors had. These are your typical bread and butter 2,000 square foot homes that are bringing in almost $1,800 a month, between $1,650 and $1,800. There's a duplex right around the corner from me, and once again, these duplexes, they're a little bit older, and they require more maintenance. What we've seen on the duplexes, though they do cash flow, we see that the investors have driven up those prices because it's based on income rather than based on the value of the sticks and the bricks. We found that you could buy 2 single families next to each other for less than the same duplex down the street. I don't know. It's just kind of Austin. I'm not. I'll show you the duplexes when you come out, and 4plexes if you want, or multi-family, whatever it may be. But we oftentimes just end up with something like this. Now this is a little bit higher end. This is a model sale leaseback that I did a couple of years ago. And then this one actually is a home that I have listed, and this would be on the high end of a rental property, but it's 3,200 square feet, and you could expect to get about $2,500 a month, 2,400 to 2,500, right, Mike, on an Avery probably, and this listed at 259 or 269, and so that's still 1% of the value. The rent of the value is the rental amount, so it's pretty good numbers here. So these are real life sample performance based on the current, with just 20% down. With prime lending, 20% down, no PMI. Closing costs plus or minus $4,000. You're looking at about $30,000 to close. 104 loan amount. But look at that payment. 4.25% for $100,000 is $512. It's like almost free. And then a tax rate average right now is about 2.4. Avery's 2.55. We have some areas locally here that's 2.2 or 2.1. I know people complain about the higher taxes here, but bottom line is we don't have a problem with our school systems going bankrupt. So it's good for our tenants. I mean, I know not to poke fun at Mr. Schwarzenegger, but the bottom line is that that's one of the reasons why a lot of companies are actually moving here from California, is they're concerned about their children's education. Plus, we don't have state income tax, so that's another savings. We don't have that extra 10% you lop off the top of your income. Okay, and so total payment is $832 with Rick's 9%. Is it you still 9%?
It's 8% actually, Ken.
So it's 8%. Wow,
Even better.
give them a bonus here. So yeah, so it's about $10 less a month than this. And the reason why we had it is because we had a special deal with the renter clients on this, and so I thought it was 6% the first year and 9% the following years, but 8% sounds good to me. So you're looking at a total payment of $946, even with just 20% down, and the rents on this are $1,275 to $1,375. I know that Michael rented what was it, Rajesh's house out for $1,395.
That's correct.
Yeah.
That was in Town Park Center.
Yeah, in Cedar Park Town Center, $1,395. He paid about $140 for that property, and he's getting $1,395, so about 1%. Take a look at this performer, about $150. You're looking about $30,000 down, and you could put more down, and that'll bring that payment down. About $33,000 into it. And once again, we're trying to buy property under market. It's not a 20% off market or a 10% off market. It's just not that way. We're actually seeing multiple offer situations. And it can be frustrating for investors because they find a good property and we've got to fight off the other investors. The investors are back, and hopefully you'll be one of them. But it's not like I've heard from in California where you're having 27 offers on one probate. It's still an opportunity to get your foot in the door. And so here's $1,000, and $1,071 is your total payment with management. Now, there's some numbers that are not in there that you need to factor in, which I ran out of space on this, but you have vacancy factor. You have leasing fees, and you have maintenance and management. The only thing is that so add about another $100 a month. The thing is, people aren't moving as often, so your vacancy factor is down. So there's less leasing fees. So it's figure about $100 for maintenance and $100 for management and vacancy, and you probably got some pretty good numbers. Next month, I'm going to show you a software that we're going to be offering to our clients for very inexpensive. In fact, for free for trial, that allow you to plug all these numbers in and automatically spit it out at like a spreadsheet on steroids. So I think you'll have fun playing around with that. And that's REIC software. And then here's 175 purchase. And then Rick and Mike, if my rents are right, isn't that about right for 175? About $1,450 to $1,600.
Certainly the 1,600, 1,450 be a little on the low side.
So okay, so see, so it's a little bit low on the downside. It wouldn't be more than 1,600, 1,650 maybe, or
it might be 1,695.
16. Okay, so we're almost back to that 1% rule, which was hard because we never really quite got to the 1% rule in Austin, but now we're there. So my numbers are, shame on me, my numbers are a little bit low, but still you're going to see a positive cash flow right off the bat. I mean, of $300-400 a month. And I looked at the cash on cash return on this just from the down payment. and the cash-on-cash return was closer to 8%. So, even after the factoring in vacancy and the leasing fees. So I can do a much better with the RIC program. I'll be good. Any property that you are interested in or that I present to you will have very detailed information that you would need to help make a decision. Usually, and here's a $200,000 purchase. I put $1,550 to $1,800. It's probably more like $1,650 to $1,800 on the rent. But look, your payment's $1,294, and you're throwing off $300-400 positive cash flow or more. This didn't happen before. So yeah, this is why we call it Cash Flow City. So, all right. A lot of my clients ask me, well, what do we do? And what I suggest that you do is you give me a call. My phone number's been on the bottom of this list from the very beginning. You got my email address. That's my cell phone number. Realize that I work one-on-one with my clients. I do have a team that handles paperwork and sometimes handled opening up some doors. But bottom line is that I'm with you from beginning to end. Give me a call, contact with me, and I'll discuss plans and strategies, and we'll help make you an application with the lender and get you set up with Rick Ebert and Michael Ebert on property management. I mean, this is a turnkey operation. I've been doing this over and over so many times, but I've never seen the returns that we've got. What we oftentimes do is have you fly out here. If you want, I highly encourage it. Come out on a Friday, spend Saturday looking at property, maybe Sunday, half day, and then make a decision, or fly on back and don't buy. But most people do buy. Usually if they come all the way out here, they want to buy something. But even if they don't, a lot of times they'll know by that tour, they'll know where are the good areas, they'll have the eyes, so that when I send them another property, that you'll actually go, okay, I know that area. That's Avery Ranch, or that's Terra Vista, or it's Butte, Hayes County, or wherever it is that you want to buy. That you've already seen it, and also learned to trust me as your representative. So once again, if you don't want to take a tour out here, there's another way to do this. Buy one of the properties, put it under contract, and during your option period, I have clients fly out, take a look at it. They've usually 10 days to make an unrestricted right to purchase the property or not. They usually put it under contract. We negotiate a great deal, because a lot of the good deals, you can't just wait to fly out. The good deals are going to be gone. So I call you up and we put it under contract, but you're under no obligation to close it until you come out here, fly out here, take a look at it yourself, meet with the inspector yourself, go through the property, and then make a decision whether you want to buy it or not. If it doesn't work for you, you back out and get your earnest money back and move on. If you want to buy it, then continue moving on. We'll get the property set up for property management. All right. So we're close to the end of our hour, and we'll carry over just a little bit, but I hope this is helpful for you. Okay, the best compliment I can get from you is referrals. And if I'm not doing my job and you're not happy with me, you're not going to refer me anybody. And that hurts my feelings, but it also hurts my pocketbook, because a referred client is so much less expensive than acquiring a new client. So please, I know there's people on this webinar that have referred me clients, and I appreciate and I thank you, but it's the highest compliment I can get. Let's go back here. All right, so some more information coming up. The next real estate webinar, last Wednesday of the month, we're going to talk about the single-family residential retirement strategy. We're going to talk about the single-family residential college fund. Another thing that I've purported over the years is 10 homes in 10 years, and I think Rick's been a big fan of that. A lot of his clients build up one property per year for 10 years, and and Rick's done it. We'll thank you for the sponsors. I think Mike actually will be speaking with us. We'll have more property management statistics. I'll be happy to send you, if you remember the spreadsheet that I showed you with all the stats of all the different areas, that took 2 days for our staff to put together, because we went through every subdivision that was a cross section of where we're at. I'm glad to send that to you so that you can look at it for yourself. It's page after, it's huge, thick page. I'll put in a PDF and I'll send it to you. Along with we'll send this to you anyways, whether you like it or not. We'll send you the 97-page report from the Texas A&M Research Center. Also, Prime Lending, our preferred lender, we appreciate them. They will also be sponsoring us out there in Irvine, and hopefully we'll get Sherry to come out with us, and Michael, her husband, who's also a real estate broker here in the Texas area. And then we'll have the REIC investment software that I think you're going to find very valuable. Once again, the Irvine Hyatt Regency, it'll be streamed live. So if you can't make it down there, we will give you a link so you can stream it live and watch it from the convenience of your own computer. That's going to be the 24th and 25th of October, 7 and 9, and it's going to be a lot of great information. And I'm going to be offering a membership to my new mentoring and networking club, which is Real Estate Investor Club. It's a free membership, and we're going to connect with, mentor, have other people mentor us. I always like to invite millionaires and billionaires. If we can get a hold of a billionaire, we'll get them in there. And also networking, and this is networking for serious investors. So we'll be, plus there'll be quite a bit of education involved in that, and I'll be actually giving away, as part of my membership to the VIP membership of the club, where I do my teaching. We'll be teaching out of the Real Estate Investor Millionaire, which is Gary Keller's, Keller Williams' CEO's, the chairman of the board, his #1 selling bestseller, New York Times bestseller on real estate investing. They also co-wrote a book called Flip, which is about how to flip, and then another book called Hold, which is just brand new coming out, which will complete the series, and that'll be what we'll be teaching out of in the months following this convention. All right, well, we're sailing off into the sunset. I'm only 4 minutes over, and I appreciate any comments or questions. We'll call this as the basically the end of the webinar. You've got my contact information. I will be sending you once again my contact information along with a link to this YouTube video, this presentation, so you'll have a YouTube video. There is opportunity to ask questions on this GoToMeeting. I'm not an expert at GoToMeeting, but if you had any questions, go ahead and shoot them over to me, and hopefully I'll answer questions for others. And if not, I'll give you about 10 seconds to do that. And if not, then we will go ahead and say thank you very much for your attendance, and I appreciate it. We'll be in contact with you. Contact us, call us, email us, text us. We're here. We're here to help. God bless you, and we'll see you at the top.